Senior money isn't cheap money, it's paranoid money. It gets paid first. It asks the fewest questions after it's protected, and it assumes that something will go wrong, because something always goes wrong. I'm Jesse Welch. This is Capital Letters. Hey, by the way, welcome to Bangkok. So today I want to take a little time and sort of strip down senior lending to what it actually is. Not what like pitch decks say, not what founders hope that it is, and not what brokers imply that it is. You see, if you understand senior debt, then you're going to understand how every other layer of the capital stack behaves. Senior debt is the most important, and with any sort of project that you're attacking, senior debt is the most important piece. It's the piece that you should put in first, and that's why I want to talk about this pretty early on. Senior debt is actually not about return. It's about control, and it's about survival. Senior debt is the foundational layer of most capital structures. It's not the most interesting. It's the most boring. It's not the most flexible. It is by far the stiffest. But it is absolutely the most powerful thing when things stop going according to plan. At its core, you want to think about senior debt as contractually prioritized, legally enforceable, and then structurally it's designed to get paid first, right? Senior. That first, by the way, it matters more than almost anything else in finance, because capital stacks, once you start getting into them, they are not theoretical. The theory is really interesting, but capital stacks are execution orders for when reality intervenes. Senior lenders do not participate in the upside the way that equity does, right? That's why they don't really care all that much if your valuation doubles. They care if their principal comes back intact with interest and on time. This leads to a really critical mindset difference. Equity is asking, what could this become? Debt, and especially senior debt, is asking, what's the worst thing that could happen, and how do I still get out whole? That is why senior debt is priced lower. It's not because it's cheaper money. It is just way better protected money. Hence why senior debt tends to come from banks, right? They're the most protected. They're taking your checking account and investing it so they can make money, so they can't lose it, right? A common mistake, especially among founders, is assuming that senior lending is friendly lending because the rate is lower and because the lender sounds conservative and, you know, the documents, they look standardized. No, that's actually backwards. Senior debt is less forgiving, not more. See, equity can tolerate ambiguity. Senior debt cannot. And when you're going for this kind of debt or this kind of money, you need to keep that in mind. Once senior debt is in the structure, the business no longer belongs entirely to management. Time horizons compress. Optionality gets priced out. This is not bad, it's just real, right? So the core truth, and I'm going to say this slowly, indirectly to the camera, senior debt is not betting on you winning. Senior debt is betting on the assets being worth what we think they are. They're betting on the cash flow showing up when expected. They're betting that the legal rights are going to be enforceable, and they're betting that the downside scenarios are survivable. That is what senior debt is looking at. If those conditions aren't true, senior debt is just not going to show up, or it'll show up with terms that you won't like. So the reason this matters, and honestly, I think this segment and this episode matters, before anything else, if you don't internalize what senior debt is, then covenants are going to feel arbitrary. Collateral is going to feel intrusive. Enforcements are going to feel aggressive. But if you understand the role that senior debt plays, everything downstream is suddenly going to make a lot more sense, which is exactly why this next segment matters. Once you understand what senior debt is, the next question is really where this sits and why that position gives it so much leverage. All right, where does senior debt sit in the capital stack, and why that position is everything. If the capital stack were a lifeboat, senior debt gets a seat. Everyone else, they get a compelling narrative. The capital stack is not a diagram, it's a liquidation order, and you want to think of it that way, right? People like drawing the capital stack as like these neat horizontal layers, and I think that's really adorable, and it's a great way to kind of understand it. In reality, you want to think of the capital stack as like a waterfall under stress. So when things are going well, the stack feels theoretical. It's a beautiful waterfall, and you're taking pictures, and maybe you're changing your f-stop and your frame rate to make it look even like, oh, like it's cascading perfectly like a cloud. But here's the thing, when things go wrong, it becomes procedural, and it turns into more like a whitewater rapid, and you are about to fall off that waterfall in your little dinghy. Who gets paid first? Who gets paid later? Who doesn't get paid at all? Right? That order is not philosophical. It's written and it's enforced. And senior debt sits at the very top of that queue. So if you are a banker, keep that in mind. If you're a private lender, you probably already know this, but if you're a founder or if you're somebody looking for capital, this is something you have to understand, right? The actual hierarchy, not the romantic version. At a high level, when a company fails, sells, or restructures, senior debt's going to be first, senior unsecured debt second, then your mezzanine or your subordinated, and then you're going to have your pref, your common, pref equity, by the way, common equity, sometimes subordinated equity or strategic equity. So notice anything? By the time equity gets involved, the outcomes have probably already been decided, right? Senior debt is not hoping that the company survives. They are, but they're not betting on it, right? It's structured, so they don't really need the company to survive if it's built correctly, right? It's not just a title. Doesn't mean older or wiser. It means legally dominant. Senior debt is legally dominant debt. Subordinated debt is not that, right? Senior debt sits closest to the assets, closest to the cash flows, and the enforcement mechanisms, which means senior debt or the lenders, they do not argue about value in upside scenarios. They argue about recovery in downside scenarios. That is what they care about. They care about liquidation value, not EBITDA multiples. They care about appraisals, not projections. They care about enforceability, not optimism. So this is also why senior lenders and banks, they obsess over lien priority, intercreditor agreements, if you're doing like a club deal or something like that, and perfection of security interest, because seniority only matters if it holds up in court, because these things end up in court all the time. Control is the real yield. That's what they're looking for. So this is the part that people don't really like hearing. Senior debt earns interest, but it buys control, right? It's going to buy control over cash flow through your covenants, assets through collateral, decisions through defaults, and then timing through maturity structures. Like if something breaks, senior lenders are not going to ask permission. They will generally work with you, but they will do what they're going to do, right? They're going to trigger remedies. It does not make them villains. It just makes them exactly what they said they were in the credit agreement. And remember this, when you think senior lender, think bank. When you think bank, think your neighbor down the street who's a teacher, their checking account, their savings money is being lent to these businesses. That's why it's so important that they don't lose. But if you can get your senior lender in place, mezz lenders are going to price risk above it. Equity is going to absorb below it. And you're going to learn how to use this tool a lot better, right? You're going to understand why mezz exists at all, why preferred equity demands protections, why common equity gets diluted or wiped out or restructured every time. It's not because the investors were wrong. It's just because they knowingly stepped below the senior debt. At least good investors are supposed to, right? That's why you see pricing differences. The brutal but very useful truth about senior debt is that it doesn't win because it's smarter. It wins because it goes first, right? And in finance, going first during distress is almost always the difference between impairment and survival. So why this matters before we talk about collateral or covenants, I want to make sure If you don't understand where senior debt sits, like I said earlier, collateral can feel aggressive. Why do they want so much? Covenants feel punitive, right? Defaults feel personal. But once you see the stack clearly, you realize that senior debt is not hostile. It's structurally just very honest and very simple, right? It sits at the top, which brings us to our next uncomfortable topic. Because if the senior debt sits at the top of the stack, the next question is how it stays there. The answer is collateral. All right, what even counts as collateral? What senior lenders actually care about? Collateral is not about what looks valuable. Collateral is about what can be taken, what can be sold, for how much, and enforced, and fast, really. So, what collateral actually is, it's not a vibe. It's not a pitch deck slide. It's not enterprise value. This is the reason that venture capital is almost always equity. It's almost never debt. Venture debt is a whole other thing. Collateral. Collateral is property a lender can legally seize and monetize if you default. Full stop. If it cannot be clearly identified, if it cannot be legally pegged, if it cannot be perfected under law and protected under law and liquidated without some soap opera, senior lenders are going to discount it very heavily, or they're going to ignore it entirely. And this is why technology is very hard to lend against. The big categories of collateral in reality, most senior secured loans are going to be backed by some combination of the following. It's going to be hard assets, financial assets, cash flow proxies, or enterprise-wide blanket liens. So I'm going to go into these. These are the most common hard assets, right? This is the gold standard. This is the stuff that senior lenders actually like. They love this shit, right? Examples are real estate. That's a big one. Equipment, machinery, vessels or aircraft, energy infrastructure. The reason that senior lenders love these, they are independently appraisable. There are companies like Colliers, and this is all they do all day. By the way, Colliers, I'm open for sponsorship. Their resale markets exist, right? Liquidation pathways are known. This is why asset-based lending exists at all. But there's a catch there. Hard assets are really only valuable if they are titled correctly. If they're not already pledged, that happens all the time. It's illegal. If they're insured, usually, almost always actually, and they're not like custom built nonsense that no one wants. So there has to be a secondary market for it. I did a loan one time for slot machines, right? Very valuable, great secondary market for it, but very illiquid. And illiquid is not good, right? It's just, people don't like that. Number two, financial assets. These are marketable securities. Cash, right? Receivables, those will usually get a discount. Inventory, these things look great, but senior lenders are going to haircut them aggressively. The reason why is because receivables age, inventory becomes obsolete, cash usually moves unless it's controlled, right? So these loans, they generally come with eligibility tests, reserve requirements, borrowing bases. Senior lenders are not going to assume full value. If you have like $100 million in oranges, they're not going to use that as like $100 million in collateral, because by the time they get it, like half of those oranges might have gone bad. So they're going to assume the worst case collectability. That's how they survive. Number three, cash flow as collateral. I'm going to be careful. We're going to clear something up. Cash flow is not collateral exactly. It's support. So senior lenders, they lend against assets and they underwrite to cash flow. So there's a crucial distinction here. Cash flow matters because it services the debt. It delays enforcement and it reduces the default probability. So that's great. But the problem is when things break, cash flow disappears and assets don't. So that's why senior debt is not like cash flow only, almost never, unless it's unsecured senior debt, which is not super common. That's an entirely different beast, to be honest. And I say this all the time. When a lender, they're looking for three things. They're looking for, how am I going to get paid back? What's my collateral? And then those guarantees. In that collateral is where you're going to find these. Number 4 is blanket liens, right? Is there something that they can put a blanket lien over, like all of the assets or the present and value of like the shares afterwards? It's prevention, right? Blanket liens stop borrowers from pledging assets elsewhere, stops them from structurally subordinating the senior lender, which occasionally happens, and it stops them from getting really creative during distress. Senior lenders do not like to chase value. That's why they want to freeze the board, right? And add board members sometimes, often. So what senior lenders quietly ignore, and here's what does not excite lenders, is brand value. They don't give a shit about your brand value. They can't use it. Goodwill, doesn't matter. Strategic importance, that's for the equity people. Projected synergies, management confidence, if it cannot be seized or sold, it does not belong in the collateral conversation. That doesn't mean it has no value. It just means it has no priority value. Balance sheet lenders, or lenders that lend based on balance sheet and then senior lenders, you want to think of them as completely different beasts, right? And this is why collateral drives everything with senior lending. It drives leverage limits, pricing, covenants, advance rates, default remedies, which means if you misunderstand collateral, you are misunderstanding the entire loan. So when you're thinking senior lending, think collateral is in there really deep and very important and very big. So if collateral explains what senior lenders rely on, the next question is, how do they protect it? And where covenants come in. Senior lenders, they do not underwrite upside. They underwrite survival. So first, I want to kill a myth. Founders think senior lenders are asking. They think senior lenders are asking, how big can this get? Senior lenders are not asking that. They don't really care. What they're actually asking is, how do I get my money back if this goes wrong? That single difference explains everything about senior debt. A senior lender's mental model, they run a downside first model. Their underwriting stack is really going to look more like this. They're going to want to know what assets exist today. They're going to want to know how quickly do these assets deteriorate, how predictable is cash flow under stress, how much control do we have if things break. They want to know how many ways can we exit this thing whole, or mostly whole. Growth is optional, right? Recoverability, that's mandatory. So what they actually underwrite, not necessarily in order, but like generally in order, from my experience, they're underwriting asset coverage before cash flow, before EBITDA, way before forecasts. They're asking, what are the assets? Who owns it? Is it pledged? What is it worth in liquidation? And like, not in theory. Because if asset coverage fails, the deal usually just dies right there. Number 2, now they're underwriting cash flow. Even the cash flow lenders tend to underwrite the assets first. Cash flow durability, more importantly, not growth. Senior lenders don't really care all that much if revenue doubles. They do care if revenue collapses by 30% though, or even 20%. A lot of them are starting to put the line down there. They care if cash flow stalls for 12 months or faces customer concentration risk. So they're going to model downside cases. They're going to model recession cases. They're going to model, oh, my key customer disappeared. Microsoft is no longer our customer and 80% of our revenue is gone. They're going to model that because stable, mediocre cash flow beats explosive, fragile cash flow every time. And I've been a part of these scenarios, so trust me when I tell you that is absolutely the case. They're also going to underwrite leverage tolerance. Like, they're not asking how much debt can this business carry. They're asking how much debt can this business carry while everything is on fire. So that's why leverage caps, they feel really conservative with senior debt. and lenders are always pushing amortization, right? Covenants tighten when risk rises. It's because they're not optimizing ROE. They are minimizing regret and control mechanics. Senior debt is about control. It's not about partnership. A good senior lender will be a partner, but it's not like about partnership. It's about control. They care very deeply about covenant tripwires, reporting frequency, audit rights, consent rights on asset sales, the ability to block junior capital as well. If they can't step in early, they price higher or they walk. And especially like if a bank or senior lender, they don't want to play, they don't want to set up an intercreditor agreement with some second position. I've been there and worked with a second position that actually intentionally tripped up an entire deal because they wanted to come in and buy out the senior lender and then fire sell the asset for like half price. And then they would make like $5 million. Senior lenders, they don't want that. They don't want the headache. They want to get paid. What they're underwriting is how they can stay in when I say first position, like I mean first position. They also underwrite management. Does the management show a willingness to cut costs? Do they have a history of being able to navigate duress? Do they know how to manage when things aren't going well? A visionary CEO selling an upside does not help them. Experience bringing value when everything is on fire, that kind of management, that's what they're looking for, right? What they do not underwrite, and let me be blunt, senior lenders do not underwrite optionality. They do not underwrite narrative momentum or future valuation or market domination or vibes. That's Mez. Mez underwrites vibes. Equity. Equity really underwrites vibes. That's someone else's problem. Senior lenders are very much concerned with making sure that no matter what happens, they walk away with all their teeth. And why this matters for borrowers, if you pitch senior debt like equity, you end up looking naive. You get worse terms or you don't get funded. That happens all the time. The fastest way to lose a senior lender is to oversell upside and undersell risk. The fastest way to win one is to say, hey, here's how this breaks, and here's why you still get paid. Also, if you're clever, throw in there, and here's how we mitigate that risk. So now we know what senior lenders underwrite. The final question is, how do they protect themselves when reality disagrees? Covenants, the quiet machinery that actually runs senior debt. So if you think interest rate is the most important term in a senior loan, then you are already negotiating the wrong deal. There's a joke that I make: if you set the terms, or if you set the rate, I set the terms. So what covenants really are? Founders hear covenants and they think restrictions. Senior lenders hear covenants and they think early warning systems. Covenants exist for one reason. Not one reason. They exist for a bunch of reasons. Sometimes lenders will put covenants in there to force a borrower to not take the loan, and they'll keep their underwriting fee. But that's not what they're supposed to be for. Technically, they're supposed to be there to detect problems before capital is destroyed. They are not punishments. They're tripwires, but they're not like supposed to be tripwires to like make a boulder crush you. It's like a tripwire to set an alarm off so that everybody can figure out what's going on. There are two types that really matter. I'm trying to simplify this without dumbing it down. Two types of covenants. There's financial covenants. These measure performance drift, right? Common examples are like leverage ratios, fixed charge coverage, minimum liquidity, debt service coverage. If you do any sort of like cash flow real estate, you've surely seen debt service coverage ratio. There are lenders that lend just on DSCR ratios. Basically these questions are asking, is this business deteriorating faster than expected? If you miss one and the lender doesn't panic, they lean forward, which is good. The other type of covenants, and by the way, they're going to measure those over time, and that's how they look for drift. Other type of covenants are like affirmative and negative covenants, right? So they are restricting things like additional debt. They're going to restrict asset sales, dividends, M&A, CapEx explosions. Why are they doing that? Well, it's because most credit losses don't actually come from markets. They usually come from management making poor decisions under stress. A covenant breach, by the way, does not necessarily equal a default yet. This is where people get confused. A covenant breach is not the lender taking your keys. It's not supposed to be. It's really the lender saying, hey, something changed. We're going to talk now. And then that conversation can lead to all kinds of things. Ideally, if you do it right, it leads to more trust with the lender. But it can lead to waivers, amendments, pricing adjustments, tighter reporting, sometimes, God forbid, restructuring. But here's the truth that nobody says out loud. Or, well, I'm going to say it out loud. Good borrowers breach covenants all the time. All the time. I'm going to say it one more time. Good borrowers breach covenants all the time. Bad borrowers hide from them. The reason that senior lenders love covenants is because covenants reduce uncertainty, which senior lending fucking hates uncertainty. They preserve optionality. They prevent value leakage. They force honesty early. A covenant-light loan is not founder-friendly. It's lender-hostile. And those two things are not like the opposite. They're not the antithesis of each other. A lender-hostile loan gets very expensive, and it gets very expensive very fast. So is that really founder-friendly? No. These two things can be true at the same time. So borrowers' strategic mistakes, borrowers are always trying to eliminate covenants. They're trying to loosen them really aggressively. They're trying to push all the flexibility up front. It feels smart, but it's actually not. See, the smart move is to have realistic covenants, tight but realistic covenants. Clarity on cure rights, defined amendment economics, known consequences. When it comes to senior lending, ambiguity kills deals. Every time. Ambiguity kills deals, structure saves them. So how this connects back to senior debt. Like I said, senior debt works because it sits first, it controls early, it intervenes before collapse. Without covenants, senior debt is just unsecured optimism with paperwork. And that's not what senior lenders are underwriting. You always want to think of senior lender as a bank, right? What does a bank want? Stability. So we've covered what senior lenders underwrite and how covenants enforce discipline, which leaves us one final question. When you should actually use senior debt, it is not for every deal or every situation, and when you should absolutely not use it as well. If you're a sponsor using senior debt, you're not borrowing money, you're renting trust. Senior debt can be thought of as a credibility instrument. To a sponsor, senior debt is doing 3 jobs at once. It's lowering your cost of capital. It's signaling discipline to equity. It's imposing structure on yourself. Banks do not lend to cash flow. Well, they don't just lend to cash flow. They lend to predictability. Senior debt is going to reward a couple things. It's going to reward, unfortunately, boring revenue, or fortunately. It's going to reward repeatable margins, conservative leverage. It's going to reward clean reporting. If your story requires imagination, senior debt's not your friend. You're not ready for senior debt. What sponsors usually get wrong is that sponsors, they think, once the loan closes, we execute. Yeah, no. Once the loan closes, you report. A good senior loan is going to have monthly reporting, quarterly reporting. You're going to have biannual all hands meetings. You are going to be generating lots of paperwork to give to your senior lender. Senior debt turns your business into a monitored system with cadence and also with consequences. If you miss a number, you're not supposed to get punished, you get questioned. And then how you answer these questions determines a few things. It can build a lot of trust, but it's going to determine your flexibility later. It's going to determine your amendment cost. It's also going to determine whether your lenders follow you into the next deal. Senior debt, it's like the elephant. of lending. It is long-term memory capital, right? Elephants never forget. That's still a thing. I don't know. Maybe I'm old. The trade-off that sponsors are usually making by choosing senior debt, though, sponsors are saying, I'm going to accept less flexibility in exchange for cheaper, more durable capital. That is a rational trade, if you ask me, if the business is stable. It's catastrophic if it's not. Senior lenders do not underwrite upside. Senior lenders underwrite regret. Lenders are not betting. They're pricing risk. Equity guys are betting. Gamblers are betting. A senior lender wakes up every day and they ask one question. How do I get paid back if I'm wrong? That is why they focus on things like downside scenarios. They focus on recovery values, early warning signals, behavior, controllable behavior. Interest is not the return. It's very cheap, right? They're barely beating the market. I'll explain why. Capital survival is the return. Why senior lenders care about boring things like maintenance capital and customer concentration and working capital cycles, reporting accuracy, management credibility. They care about all of these things because in a downturn, spreadsheets lie. Markets also shift. They shift very quickly, especially today. Markets shift faster. It's bananas. The only thing that remains are controls. Covenants, collateral, and cash flow are not bureaucracy. They're insurance policies. And I say this all the time. There's 3 things lenders are really looking for on how they're going to get paid back. That last one is guarantees. Sometimes those guarantees are actual insurance policies. And senior lenders are looking for insurance policies, basically, literally and metaphorically. Senior lenders actually win. Well, a good senior lender actually wins by, they never accelerate unnecessarily. They work problems early. They'll usually work with you. They preserve enterprise value, and then they exit quietly. The best outcome for a lender is, hey, nothing exciting happened, which is exactly why good senior debt, it looks invisible. Until it isn't. Senior debt is not there to make money. Senior debt is there to make everything else possible. Senior debt is not there to make money. It's there to make it possible for everybody else to make money. Senior debt is the quiet constraint that turns ambition into something financeable. Before equity can dream, before mezz can stretch, before sponsors can optimize returns, someone has to anchor the structure to reality. Unless you're doing venture capital, in which case you're just gambling. But anchoring the structure to reality, that's senior's job. That is what senior debt does. Senior debt is how the capital decides what's real. Markets are full of stories. They're full of bullshit. Senior lenders, they don't buy stories. They're not farmers. They don't need fertilizer. Some senior lenders actually are farmers. There's whole banks, agricultural banks. But senior lenders, they're buying cash flow that exists, assets that already work. They're buying businesses that survive bad weather, because senior debt is the market's way of saying, we don't care what could happen, right? Show us what happens when things go wrong. That is why senior debt sits first in the capital stack. Not because they're greedy, because they're kind of not. Like, they don't make a lot of money on that loan. It's because they're skeptical. Everything else prices off of senior debt, because every other layer of capital is downstream of senior risk. This is why, like a lot of the senior lenders are banks. And this is why a lot of these banks have like a merchant bank arm and a private equity arm, an investment bank. All these other things are where they really make their money, right? Equity returns expand after senior risk is neutralized. Mezz pricing assumes senior survives first. Pref equity exists to bridge what senior refuses. If senior lenders pull back, the entire capital stack reprices instantly. That's why when banks tighten, deals stall, valuations compress, creative structures suddenly look irresponsible. Senior debt, you can kind of think of as the temperature gauge for the whole system. It is the discipline that nobody likes, but everybody needs. And here's an uncomfortable truth. most businesses do not fail because of bad ideas. They fail because, well, usually it's because leverage hides problems. Reporting lags reality, right? If your report is monthly, you're at best a month behind what actually happened. And also because discipline arrives too late. Senior debt forces discipline early. Not dramatically, not emotionally, usually, but systematically, right? Systemic discipline. It makes management confront a few things. It makes management confront unit economics, capital intensity, operational truth, and it does this before equity capital gets destroyed. And I'll say this again in a different way. I say this all the time. Most businesses don't die of starvation. They die of indigestion. Good senior debt, right? It looks boring if it's doing its job because it's showing up and it's the Tums for that indigestion. Nothing exciting happens. Nobody panics. Nobody tweets about it. The absence of drama is the signal. When senior debt becomes visible, it's already too late at that point. The real takeaway, senior debt is not conservative capital exactly. You want to think of it like structural capital. It defines how far a business can stretch, really. It defines how much risk the system tolerates, where failure stops. If you misunderstand senior debt, you're misunderstanding the entire capital stack. And that's why I think it's the most important to understand early. If you really think about it, kind of like the breakdown of what I'm saying is like equity imagines the future, senior debt survives the present. But in finance, survival always gets paid first. Thank you guys for watching. I'm Jesse. This is Capital Letters. Follow me on TikTok, Instagram, YouTube. You can go to our website, www.midcap.global.com if you like. You can find me on TikTok. I'm at Norwegian Airlines. I don't think there's a lot there. But please check in if you want to learn more about finance. The longer I go, the deeper I'm going to get into things. And eventually we're going to talk about things like investment banking. We're going to go through maybe even some case studies. And until then, go close something.